Hello there, everybody. Hello, hello, hello. Can everybody hear me okay? I am live down here on the floor. Let me know if everybody can hear me okay. Welcome, welcome. It is really a quiet day after yesterday's day. Right now, what do we see here? We've got S&P's up 52 points. And it is a very, very quiet. Just give me a moment here, everybody, because I am just getting my screen set up here. So give me a moment. New spot on the floor they got me in, so it's a little bit different, but um, all the same, you can see everything going on here. I mean, VIX traded up all the way to 22 today, all the way to 22. Now trading 19 half-ish. And what I'm going to show everybody, if I can figure the heck out what I am doing here on my computer, what I'm going to show everybody, we're going to do a continuation from yesterday. Okay, with the risk reversal. And I'm going to show you where that big, big aberration, okay, that we saw yesterday from Friday's close. I'm going to show you a P&L on that from where that closed yesterday. And then I want to show you something that happened in the VIX today. Okay, but I don't know why I am not getting this update that I need here. So again, just give me one moment here, guys. I definitely apologize. This is really frustrating on my end. But in the VIX, I'm just going to give you the heads up. In the VIX, what's there? A draft? There we go. Hang on. Now I see send. Okay. There we go. In the VIX today was the absolute opposite, of what we were talking about from Friday and yesterday. What do I mean from that? What we saw in the VIX, which I'm going to show you this morning, was a really big sell, of a risk reversal. Okay, now I think there we go. All right, can everybody see that? I am so sorry, guys. Awesome. Okay. So we're still going to talk about risk reversal. Now, first, let's look at what we talked about yesterday. Okay. So Friday, we know the VIX had closed at 69.10, and we were looking at the big aberration between the $50 out of the money options. Okay. We looked at the 68.60 put on the downside, the 69.60 call on the upside. So at the end of the day on Friday, okay, this is what everything looked like. So if we had sold the 68.60 put at $11.60, which was the closing price, okay, that's where it was on Friday. Talked about that yesterday. And if we had bought the 69.60 call at $2.85, though it's where those closed on Friday. Now, do you all remember from yesterday that the delta of that position, buying 10 calls, selling 10 puts, was 400? Do you all remember that? So in our assumption here, if we had done what many of these guys did here, and can everybody hear me again? I'm hoping I didn't lose anybody. Okay, thank you, Kent. Thank you. Okay, so if we had kept this as delta neutral, we would have sold four SPX futures, 400 deltas. Okay, this is how it all would have worked out. On the SPX futures, okay, on the SPX futures, we would have made $28,704 just on the SPX future part, being short four of those yesterday with this move down of $71.76 in the S&P. Okay, does everybody understand that? Okay, now if we had sold 10 of the 6860 puts at the close on Friday at 1160, those closed yesterday at $22. So we lost $10.40 10 times on those. Or a total loss on the put position of $10,400. Okay, 10,400 loss on the puts. Now, if we also factor in the calls that we bought 10 6960 calls at 285. Those closed at zero. The loss on the call portion would be 2850. So we lost on the puts, we lost on the calls. But because this would have been done delta neutral, that would have been the net position. That would have been the net P&L, all because of that massive, massive volatility skew. Does everybody follow that? I don't care what I did on the puts. I don't care what I did on the calls. I only care what the overall position was, which would have been an incredible winner. Okay, good. Good. Now, again, if we didn't hedge that, right? If we had just sold puts and bought calls and looked at that big disparity, that wouldn't have been good. But keeping it delta neutral, that was the outcome. Okay. Now, yesterday, at the close yesterday, okay, there was still a skew. There was still a skew, not as severe. So yesterday, we closed at no, Bushman, not when we're looking at out of the money contracts. You're thinking of at the monies. You're thinking of at the monies. So they were about 20 deltas each. So we got 200 delta long on the put side, 200 delta long on the call side, which is why we sold 4 S&P futures. Okay, does that make sense? Got to remember, yes, when the trade was created, they were not at the money. You're thinking of at the money options being 48 or 50 delta. These were not at the money. These were $50 out of the money options. Yesterday, close of the day yesterday, 68.40 was the close. Okay, so same thing. If we went $50 out of the money at the end of the day yesterday, okay, the puts on the downside were 845 and the calls on the upside, which were the 6890s, 585. So you can see much closer in value, right? Only $2.60 apart, not $11 apart, like where they ended on Friday. Still a skew, but much, much tighter. Okay, so if we had done that yesterday at the end of the close, and we'll stay with the same amount of contracts, 10 calls, 10 puts, 400 deltas, selling 400 SPX futures. Okay, We'll see tomorrow what this would have been. Okay. We'll see tomorrow what this would have been. Okay. So these were the prices from yesterday, and we'll follow that up tomorrow. Okay. Everybody follow that? All right. Cool. Now, I want to show you something that traded today, and I have to look on my phone here because my broker buddy over here. Sorry. Where is Brian? Where are you here, Brian? Brian. Here you are. Okay. Today, let's get to the live charts that I have somewhere on my screen here because this is such a mess. Okay, there we go. Let's pull up VIX. Okay, trade. And you guys can all look this up on your platforms today. You can all look this up on the tape. Um, just right. No. The second one was trades that would have been done at the end of the day yesterday. The first one we went through and evaluated that $15,000 plus gain was from the end of the day Friday. Okay. Buying power should not really be adversely affected because the position is hedged off. Okay, now in the VIX, today in the June contracts here, let's get June populated. And you can look this all up. When the VIX was trading 2130 earlier, now that's the June contract. The June contract at 2130, and I know it's probably a little difficult to see here, but you guys can hopefully enlarge your screen. Okay. Somebody sold June 30 calls at $2. And at the same time, they bought the June 19 strike puts for 199. Okay. And that was all done tied. Tied means where the stock, or in this case, where the VIX futures were at the time, to 2130 in the VIX futures. So they sold call and they bought put. Okay. Now, what do you see there? If those were the prices, and these are the 30 calls and the 19 puts, and the prices were basically the same, $2 on the calls, 199 on the puts. What does that tell you? What does that tell you? No skew, okay. Delta neutral, okay. They expect it to go down, okay. They're expecting what to crash? Something is way out of whack here, guys. Remember, Futures are 21.30. 21.30. Puts are expensive. I think just the opposite of all of you. I think absolutely the opposite. How far out of the money are those puts that traded $1.99? How far out of the money are those puts? They're out of the money. Bill, futures are 21.30. These are the 19 strike puts. Come on, guys. I'm not trying to trick anybody here. There you go. Kevin's got it. $2.30 out of the money. Right? How far out of the money are the calls? How far out of the money are the calls? Anybody? Well, how far? Yeah. No, not 130. $8.70. So we're looking at options that one is $8.70 out of the money, one is $2.30 out of the money, trading the same price. So where is the skew? Which option is more expensive? Not more expensive because one is $2 and one is $1.99, but which option is more expensive? Where is there way more premium priced in? No. How can you say the puts, guys? The puts have $2.30 of premium, of extrinsic value in them. They're $2.30 out of the money, right? And they traded for basically $2. The calls are $8.70 out of the money and traded the same price. The calls are way more expensive than the puts. The calls are way more expensive than the puts. Okay, which tells you here that the person putting this on sold those calls, bought those puts, and then bought the VIX because that would be the hedge, looking to take advantage of that massive volatility skew. Does that make sense to everyone? They are short negative delta, Robert, which is why they bought VIX futures. That's why they bought VIX futures. Just like in our synthetic equation, buy put, buy stock, sell call. That's the equivalent equation. Okay, so I wanted to, because this traded today, I wanted to bring that up. Okay, word of the day today, guys. It is gold once again, but this time we are featuring the ladies, the women's USA hockey team. Couldn't just have the men up there. So we are gold once again. And while you're all doing that, anybody that wants to pop in this afternoon, I am doing a live webinar at 3:30 this afternoon. Normally we do these at night, but because of the State of the Union, I am not doing it tonight. I am doing it after the close at 3:30 Central Time today. So if anybody would like to pop in, and then also, Mike, if you can put up a link to our trading challenge that we are hosting with Interactive Brokers. For those of you that have not registered for that yet, it is a free trading challenge. Get to trade against everybody else in there. We are hosting a webinar tomorrow right after the close with Interactive Brokers to kind of explain the challenge, the platform, all that good stuff. There is the link up in the chat. Okay. So we got the webinar after the close today, and we got the intro webinar with Interactive Brokers tomorrow to discuss our trading challenge. Please, please, please sign up for that. It'll be a fun challenge. Doesn't cost anything. Lots of great prizes. It's our March Madness challenge that we are hosting. Right. So we will look at these prices at the end of the day tomorrow, because this is where things would have been put on at the close of the day yesterday. The wheel is closed for today, guys. And I don't know if you guys can see. I'm actually on the opposite end of the S&P pit. I moved over here because they're building out actually the TV and camera space up where I was. So I moved over here now. There will be no after hours today or tomorrow. There will be no after hours today or tomorrow. Okay. Yeah, AJ, that's exactly it. It's a lot of trial and error. It's a lot of scanners. Everybody's got the scanners going, going off about what's happening with this skew. Unless you're watching the markets, constantly, or you have a scanner pointing this out, you're not going to find it. You're not going to find it. But definitely, if you have something there, like Kent just said, paper trade it for sure. All right, guys, let's get the wheel here. Yeah, start having to have some cup colors there soon. All right, today's winner is Franco or Jeffrey. Is it Franco or Jeffrey? It is Franco. Franco, you still in the house? Franco, you still here? Yeah, again. Oh, it's getting boring for you, huh? It's getting boring for you. All right, everybody. Appreciate you. I will not be on the floor tomorrow, but we will be continuing this. And I don't mind continuing on with the skew risk reversals, since it really is, kind of an indication of market sentiment at any one time. And because we're in this period that we're seeing this, skew that is really out of line. It's coming back into line now. But if it's still like that, I think we'll continue with this. All right, everybody. Sign up for the webinar this afternoon, 3:30. I'm hosting it live. Sign up for the webinar tomorrow that we're hosting with Interactive Brokers about the trading challenge. And we'll see you all tomorrow. Bye-bye.